Hi gang, it's Jeff, and welcome to another video. In this video, I show you what you need to do to be ready for retirement in 5 years or less. Coming up next on Holy Schmidt.
Holy Schmidt!
In 1965, American psychologist J.C.R. Licklider said people tend to overestimate what they can do in 1 year and underestimate what they can do in 5 or 10. No truer words were ever spoken than this statement applying it to personal finance. With a piece of paper and simple 5th grade math, you can dramatically change your direction if you focus on what to do and what not to do over the next 5 years, and most importantly, acting on that information. In this video, I'm going to show you the biggies on where to focus your effort so that you can be retirement ready in 5 years or less. All right, let's get into it, but before we do, please make sure you click subscribe notifications so that you get alerted the next time I post a video. I post about twice a week. Also, at the end, I'm going to show you how to download my free retirement ready checklist. I'll give you the exact details on how to do this. It's free, it's my gift to you, so make sure you stick around to the end so that you have that information at your fingertips. All right, let's get into it. Let's talk about the way the world looked when you entered the workforce and the way that it looks today. If you're watching this video and you're about 5 years out, chances are good that you were born around 1960, plus or minus a few years. In 1960, you probably came from a home with one breadwinner, probably your father. Remember, this was 1960, and 3 out of 4 workers in 1960 were male. And if he worked for the same company most of his life, he knew exactly what his retirement pension plan looked like and exactly when he was going to retire. The type of pension plan that your father had was more than likely what is called a defined benefit plan, because the payments are defined, they're specific, they're guaranteed to the recipient by the company. Unfortunately for him, the average life expectancy of a 65-year-old born in 1940, which would be about his age if you were born in 1960, was age 70. So your father got to enjoy retirement for approximately 5 years before his time expired, if he made it to age 65 at all. The good news, though, is that if you were born in 1960 instead of 1940, at age 65 in 1960, your average life expectancy was age 77. So you were 7 years longer in retirement than your father. Today, by the way, at age 65, the average life expectancy of a male is age 82, so they got it wrong even back then. But I digress. So at the time you were born, you were going to cost the company twice as much, almost 3 times as much as your father was going to cost the company in retirement. At the time, the math was not widely known on the extent of the liability on this, and so company personnel and actuaries made some pretty wild assumptions in order to ensure that the defined benefit plan carried the employee to age 77. In the end, the math didn't work, and the defined benefit plan took many a company into bankruptcy. Then in 1978, something happened to change the game in favor of the employer, the birth of the 401k plan. With you costing 3 times as much as your father in retirement, the company couldn't afford to give you a cushy retirement package like they did back then, but with the 401k, they didn't have to. They could contribute a specific amount, and the investment choices, the returns, and more importantly, the income in retirement was entirely your responsibility. So here you are about 5 years out and you're wondering what to do. Some of you may be lucky and have a defined benefit plan, but my guess is most of you do not. So the first thing you need to do is understand what your numbers look like today, knowing that you have about 5 years to improve upon them. After we figure out what the number looks like today, we'll spend the rest of the video talking about what to do between today and 5 years from now. All right, let's start off with where you are right now, assuming no raises. Take out all of your bank statements and put them in front of you and list all of the revenue coming in. Your income from work or your business, your income from your investments, your income from side businesses, any type of income you have coming in, put that in on the top line. And once you have that, divide it into income that you have coming in from your job and income you have coming in from everything else. Now take any assets that you have in your 401k, your IRA, etc., add them together and divide that number by 25. The amount of income you have coming from your investments plus 4% of the amount you have in your retirement account today is the amount you have, effectively the cash flow you have to live on, X things like Social Security, which we'll talk about in just a second. Now go to the Social Security website or simply use one of these online Social Security calculators to determine what your payment's going to be at different ages. If you're retiring at 65, the payment's going to be higher than at 62, but it's going to be lower than age 67 or even 70. Add that all together, and that is your number as it sits today. Now, we're going to work on improving that, but as of today, this is the amount that you have in terms of your spendable income in retirement. While you have your bank statements, list all of your permanent expenses and semi-permanent expenses on that same sheet of paper. Permanent expenses are things like your property taxes, your utility bill, your insurance premiums. Semi-permanent expenses are things like your mortgage, your car payment, things that go on for a significant period of time, but eventually they do end. Now that you have all of this information, I'm going to show you what to do with your non-permanent and your semi-permanent expenses so that you free that up for additional cash flow in retirement. First, your non-permanent expenses. Pay off your credit card ASAP if you have a credit card balance. This is quite possibly the most damaging type of debt anyone can have, and frankly, it's useless debt. When you take out a credit card and you charge something on your credit card, if you don't pay it off immediately, oftentimes it lingers out there for years. The average person who has credit card debt on their credit card will pay 5 times as much on that amount that they borrowed than someone who pays it off every month. Once you've paid off your very high interest credit card debt, excess cash goes into your retirement account, your 401k, your IRA, your Roth 401k or IRA. Any tax advantage account has an advantage, no pun intended, over a plain account at a brokerage firm. If you think you're still going to fall short, consider a side job, a side gig, a side hustle, I think it's called today, and use that income to fund your retirement account. Make sure it's something that you enjoy because, frankly, you may want to carry that side job into retirement, and it would be great to have something that you do that you actually enjoy doing 5, 10, 15, 20 hours a week. The important point here, that side income, if you choose to go that route, should not be used for personal enjoyment, new cars, clothes, vacations. The entire purpose of the side job right now anyway is to pay down debt and to overfund your retirement. By the way, I will put out a video shortly on how to find the ideal side job for those approaching or in retirement. So make sure you click subscribe notifications so that you get alerted when I post that video. The next point is after you've paid off your credit card and after you've maxed out your tax-advantaged retirement accounts, any excess cash goes into paying off your primary residence. Now, a lot of you are saying, well, yes, Jeff, but I can get a better return on my money in the market or some other type of mutual fund. Why would I take that money and put it into my home? For 2 good reasons. The first is that the risk associated with paying down your mortgage, that you actually be able to pay down your mortgage, is 0. Meaning if you make a decision to invest your money in your mortgage, you're going to pay down your mortgage. The risk that you lose money or you don't get the returns that you're looking for when you put it in the market depends on the investment, of course, but the higher the return, the higher the risk. And most people value safety in retirement over additional risky income, to be completely candid. Finally, if you've paid off your credit card, you've maxed out your retirement accounts, you've paid off your mortgage, now is the time to then put the balance of any cash flow that you have into investments outside of your traditional retirement vehicles. But really important, moving your semi-permanent expenses like your mortgage or your car payment off of your ledger gives you the cash flow to do other things in retirement. Also, having the flexibility to choose what your non-permanent expenses are in retirement means that if you decide that you want to buy a new car at some point into retirement and you have the cash flow to do it, of course you have the cash flow to do it. But you don't have to, and that's the point of moving a semi-permanent expense off of the ledger completely. It's up to you. The next point, almost everybody misses this, is protect your credit score. You've spent a lifetime building a credit score. Now is not the time, or retirement is not the time to let it go by the wayside. You'd be surprised at how often you might need to take out a loan of some sort, and having a high credit score in retirement is really important. Also, if you don't have a high credit score, 5 years is a long time to improve your credit score. There are a lot of videos out there on how to improve your credit score, and almost all of them give 2 to 3 years as the window to have the maximum impact. After 2 to 3 years, the benefits continue to accrue in improving your credit score, but not quite as dramatically. So certainly 5 years and out gives you the opportunity to really build your credit score. The next point is to understand what your insurance needs are going to be in retirement completely. I'm talking primarily about health insurance, Medicare, Medicare supplements, but also for those of you that are retiring before age 65, what are you going to use to protect yourself in the event that you have a medical need that requires a doctor? You don't really want to pay cash for your medical treatment. Also, if you want to protect others and you aren't happy with the amount that you have in your retirement savings, or you simply don't look at that as the only amount that you want to pass to your heirs, make sure that you understand what your life insurance options are, and finally your long-term care insurance options, because long-term care in retirement is really, really expensive. If you have long-term care insurance, this will help smooth the path in case you ever need it. As I mentioned at the beginning of the video, all of this comes together if you download my retirement ready checklist. You can get it at hollyschmidt.com/checklist. Thanks for watching my video. I sincerely hope you enjoyed it. There aren't a lot of channels here on YouTube that focus on retirement and retirement related planning, and I'm happy to bring you some of the most current information available in this area. If you like this video and you want to see more of me, please make sure you click subscribe and turn on notifications so that you get alerted the next time I post a video. Most weeks I post at least 2, sometimes even 3 times a week. Also, check out this video. It's one that YouTube thinks that you'll enjoy, and they're quite good at picking winners in this area.